Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on Bazaar Morning Call. Well, it's a season of conferences and we are coming to you from one of the best in the business, the Morgan Stanley Investor Forum 2026. And, as you can see, I'm in an outdoor location, but my colleagues Nigel and Dreama are very much in the studios right now. Guys, good morning.
Hi, good morning. It's a perfect time actually to get in all the smart people about money, the smart investors, about what's happening. The FIs continue to pull out from the Indian markets. Yet again, yesterday, a large sell figure of 8,000 crore. Look at the way crude prices have moved. Yesterday, when we closed the Indian markets, Brent crude was at $93.5, $94. Now we're at 97, and the war continues to simmer on. And every now and then, like yesterday, you get a little bit of an explosion.
Well, that's right. And, the Mumbai monsoon has started. Rains here, overnight. It's a trickle. I don't know whether it's going to trick us this year, but a trickle, cooling down the weather a little bit, looking quite beautiful this morning as well. I'm not sure about the markets, but at least Mumbai looks far better this morning. Prashant, take over.
It looks better, Nigel, I can tell you that. I mean, I drove all the way on. I took the sea-link and it's looking beautiful. Yeah. I hope the rains stick around and they're not it's not one and done, right? And much needed, absolutely hot, sweltering last 1 month or so. So that's one of the many wishes we have. The other, of course, wish is that, things turn around in terms of sentiment, because I think we are at an extreme at this point in time. And that is essentially what we will try and do in just a bit from now. Rhythm Desai is going to be with us, and we'll ask him what will it take for sentiment to turn around. And that's going to be the key focus area. But as always, just to run you through some of the top-down stuff which we are watching out for this morning. So oil's jumped up a little bit. We're at about $96 a barrel. There's reportedly military activity once again, not large scale, but military activity nevertheless. This is all reportage and sort of commentary which we know from the Iranian side and the US side as well. US struck Iran's Qasem Island and Iran retaliated by launching drones, missiles targeting US bases in Kuwait and Bahrain. The US Central Command says, well, all these attacks have been invalidated, they've been taken down, and nothing has really been damaged in that sense. And that's the thing, and that's the number one thing to watch, because we don't know how this will develop. There are all kinds of reports on social media, etc., which say that the airspace is in the Middle East is now shut down, and all kinds of things really going around. So a bit of a flutter of activity this morning, and oil, of course, reacting and reflecting some of it. So just to sort of, take you back a little bit, U.S. equities, last night they clawed back losses, new all-time highs, but flattish, right? S&P was up about 0.1. In terms of single stock action, humongous, huge. Every day we count out more than a few names which are up 10%, 20, 30. So Marvel Technologies jumped 32% last night. And this is after, Jensen Huang of NVIDIA said it could become the next trillion-dollar company. Well, that's some backing if it needed it. Alphabet was down about 4%, and so much chatter, commentary around why Alphabet, which throws up so much cash flow, is raising $80 billion and through equity, right, to pay for its AI investments. So Alphabet was down about 4% or so. I'll just mention Indian software as well. So last night, you look at Globant, you look at EPAM, you look at Accenture, Cognizant, Gartner, Wipro. Wipro ADR was down 8%, Infosys was down about 3% as well. So there is a bit of a we saw a nice, neat 12% rebound off the lows on the Nifty IT index. We've seen a bit of a pullback last night in that sense. Here, I mean, we got a breakdown. It looked like perhaps it was a bit of a breakdown. We've been highlighting this channel. The Nifty is broken below that channel. But what's interesting is, it's kind of sort of held on to the strong double bottom, which is at about 23,270 or so. So even with bad news, the critical gap zone remains unfilled, which is, to my mind, a clear sign of strength in that sense. Targets for the Nifty, 23,800 first, 24,070, and then I guess, whenever we see this broader macro-ish turnaround, 24,280, 24,300 roughly are the numbers on the upside. And of course, on the downside, the support is a firm close below 23,270. I guess invalidates all of this. I mean, we're basically looking at 23,300, 24,300, 1,000-point range, and we've spent time in 400, 500-point blocks over the last many months or so, and I think we are kind of sort of in a way bound to repeat it. We'll see. It's an interesting session, especially because there is some activity. It's neither war nor peace. It's kind of a stalemate. But this morning there is some action, there is some activity, and oil prices have kind of reflected it. Let me toss it across to Nigel for a quick bit on the F&O positioning, and then, of course, we'll take it forward with the conversation from the Morgan Stanley Investor Forum. Nigel, over to you.
Well, the GIFT Nifty is suggesting that we could pull back a little bit. But, I've learned a lot from CNBC-TV18 prior to being employed as well. Over the last few years watching our anchors. And I recall one thing that Anuj always says. The Nifty closes in the green on the first day of the rains in Mumbai. So it's got its stars cut out. We're down close to under 100 points. We have a bit of a trickle here in Mumbai. Let's see whether or not, that sticks with regard to the Nifty closing in the green. But yesterday was a beautiful trading session. We saw a bit of a bounce from the day's low. It could have an element of weekly expiry as well that played out. But the FIs, they continue their selling ways. Close to around $1 billion is what they sold. But the DIs, well, they are battling in there. They put in the money and they offset most of the FI selling. In terms of what are they doing in the index futures? Well, they did what they're doing in the previous trading session. They added shorts. Maybe the quantum was not as large, but close to around 5,000 contracts is what they added, and they unwound some longs as well, which takes the short positioning in percentage terms to around 91%. Now, that's the highest we've seen all the way since the middle of January. So a big surge is what you're seeing. In percentage terms, from around 83% just last week, we have moved to around 91%. And you pull up a chart. The last few trading sessions, the short positions from the FIs have moved from 1.5 lakh contracts to around 2.3 lakh contracts. That's in addition of close to around 75,000 contracts in a matter of 5 trading sessions. So you'll wonder what happened. The FIs, they sold in cash. The DIs, they offset that. And they added shorts as well on index futures. There was a big short covering bounce that played out on individual stocks because there were some shorts that were added in the system. And yesterday it appeared the FIs covered a lot of shorts, particularly on stock futures. Which brings us to the levels that we're tracking. In today's trading session, you'll want the Nifty to actually make a higher high and defend the low. So that's the band you're looking at. That should be the broad range for the day. And a breach of this will give you further direction. After this, you'll be looking at around the 50 as well as the 20 DMA. But the bulls will at least want to defend yesterday's low, going by the entire cues that we're getting. The question is, the 23,250 to around 23,350 in the last 1 month or so, every time we have gone there, it's invited a good bounce. Either a 5 to around 600-point bounce. Now, this time around as well, we have gone to that level. Will it get that sort of a response? For the time being, we've done just around 200, 230 points or thereabouts. So will we go the whole hog is the question. Recent data suggests that maybe, in fact, we go up from there as well. But Qs, a little bit skittish this morning. Finally, the Indian rupee has been showing signs of stability. Yesterday, it slipped a little bit. You don't want it to slip too much. We know that this is more a sentiment barometer as well. The rupee showing some kind of stability, some kind of strength may not be such bad news. So we'll keep an eye out on that front. But the GIFT Nifty suggesting a downtick. First rains in Mumbai, normally 10 good times. Let's see whether or not the Nifty ends in the green yet again.
All right, for now, we're firmly wedged in that trading range with the kind of up move recovery that we had intraday yesterday. But let's go across now to Prashant, who's going to be in conversation with Rhythm Desai, Chief Equity Strategist India at Morgan Stanley. Prashant, it's over to you.
Well, coming to you from the Morgan Stanley Investor Forum 2026, and as always, we're sitting down with the man who's got the pulse and who sort of helps puts this conference together for so many years now. Rhythm Desai is with me. Rhythm, great to have you with us here. Thank you very much for joining us.
Thank you for hosting me, Prashant.
And it's a day when we've got some showers, some rains in Mumbai, so hopefully, it rains good news as well. But just start with the starting point, Rhythm. It's not very demanding. It's not as if this is a raging bull market. I'm just starting with sentiment is quite negative. There's a fair bit of self-loathing, I feel now, which is kind of, we don't have AI, we don't have this, we don't have that, and all kinds of things, right? So it's almost very tough to justify a kind of bullish view. So that is where sentiment is at. So just talk us through the conference and what you aim to get to your investors from the conference, the message, straight up.
So see, the interest level in India is very low. That's the bottom line. And the reason is that on a relative basis, India is not looking good on growth. It's looking very good on valuations, but it's looking very inferior on growth. So if you compare with other large markets And this is, AI is an excuse. The real deal is on growth. And this has not been the situation only for the last 2 or 3 months. It's been the situation since September of 2024, when India's growth peaked, valuations peaked, and since then the market has derated on a relative basis, and growth has been decelerating. Now, growth did pick up in the December quarter. It's actually picked up a fair bit in the March quarter. Companies are quite positive and are guiding despite the global uncertainty, despite the conflict in the Middle East. But the growth elsewhere is very strong. So the earnings growth in Korea, Taiwan, Japan, the US, even parts of Europe are way above India's growth. And this is not like a 2-3% point thing. So if India is doing 12, 13, 14% earnings growth, these markets are experiencing 30, 40, 50, and Korea is, in the hundreds.
Yep.
So that's where the thing stands. This thing with respect to foreign investors only flips when the growth flips or the growth expectations flip. It's not when the growth flips, because that will be too late, but when the expectations flip. So something has to give, say in the memory cycle, for Korea's growth to go down. Something has to give in the compute cycle for Taiwan's growth to decelerate, and so on. So that's not something that's visible. In fact, the capex in the world has been very resilient, and it has not reacted to the uncertainty coming from the conflict, which is why markets elsewhere, outside India, are all putting up new highs, and just not a soft new high, really strong highs. I mean, Korea is up 60% from its March end low.
Yeah. No, it's up 60% this year. It was up 75%. No, it's up 100% YTD, and it was up 75% last year. And of course, Taiwan has done what it has. Rhythm, the question is, so are you saying that for FII, especially FII flows to flip, how you put it, right? This memory trade in North Asia, or this entire AI capex frenzy has got to end, because those are beneficiaries. That's where that money is going. So that needs to slow down a little bit for investors, foreign investors, to pay attention to India.
It's about expectations. The expectations have to pivot. The expectations that this is going to generate more and more growth has to change. And India's growth expectations have to accelerate. So both
have to happen.
Both are one. The relative growth picture has to change with respect to forward expectations.
Is there any signs of the former happening?
No,
because
not at all. If you look at Morgan Stanley estimates, we are only upping our capex forecast for AI. And a lot of this has to do with the AI supply chain. So there is no visible sign that this is about to slow down. That's not in the horizon.
If anything, I've seen numbers which say that it's going to accelerate all the way into 2028, maybe even beyond. And you're kind of sort of agreeing with that, right? That's your expectation, estimates as well.
28 is far away, but it's there for 27 at least.
Yeah.
So if you're looking at from a near-term perspective, next 12 to 18 months, this capex cycle is pretty intact, and it is not seemingly going away.
It's not going away. No. So where does that leave us?
So India's growth is accelerating, and at some point in time, the valuations relative to growth opportunities do become attractive. And of course, see, there is a technical aspect to this. Retail investors in India are just not stopping the bid. So in March, you would have ordinarily expected retail investors to be a little bit hesitant because the markets were volatile, there was bad news, there was a drawdown. But they put record inflows, and they followed up with another strong April, and I think the May month also has been probably very strong, going back by the amount of buying that domestic funds have done. So if that bid is on, then there has to be a seller. Now there can potentially be two sellers. There can be corporate issuances, and there can be foreigners. So the other way that foreigners can become buyers is that corporate issuances resume. It's counterintuitive. But that will be good for
more supply, basically.
Exactly. That will be good for the overall bid on the market. It will be good for the BOP. It will be good. So it's counterintuitive, but issuances can make a difference here.
That foreigners can come back and participate in those issuances.
Because then they get space to come into the market. Otherwise, retail has just kind of taken them out.
But that bid has been absolutely strong.
And I don't expect the retail bid to go away because that's a secular shift that's underway in India.
And you pointed it out, you made that
argument. We've been talking about for 11 years now. And now finally that skepticism is fading. But, people are waiting that, one day retail will panic. But retail has matured in this and they are upping their equity allocation, rightfully so in my view. In the long run, this is going to pay off quite well to them.
You started by saying that sentiment, there is very low foreign interest in India at this point in time. I mean, you've done this conference, 20 plus years, Rhythm?
28 years.
28 years. And if we were to sort of plot a interest level, foreign investor level through those 28 conferences, where are we now? Are we pretty much at the lows?
No,
yeah.
we have been through these.
Okay.
Like 2011-12, I remember, was very bad.
Yeah.
But, frankly, I should have been ready with this data. I am not. We should see the data.
Yeah.
But, when we were doing this conference in the early 2000s,
yeah.
like in 2003, we used to write a conference book. Now we don't do it.
Right.
So I used to write the preface.
Right.
India's market cap in 2003 was $100 billion.
Wow.
Because I remember writing this, that 50% of India's market cap is going to be represented at our summit. $50 billion.
Was here.
Yeah, so we have come really long way, $100 billion. So it's difficult to make comparisons on the basis of numbers.
Yeah.
Because the market is now up 45x.
Yeah.
It's a much different, it's sized up.
Yeah.
It's a player in the global.
Absolutely. I started in 2003 as well, so it's a year which I remember. But Rhythm, so just to complete the foreigner point, right? This constant selling that we're seeing. I was speaking to somebody, and I was kind of surprised to hear it. That typically, and this was in response to what I asked. Is that typically we get asked whether foreigners are calling up and asking what should we buy. But this gentleman, again, a foreign firm, said, I'm getting questions of what can we sell to increase allocation to these other markets that you were talking about as well. Is that something you pick up as well? Because that foreign selling is showing up on the screen every day.
Foreigners are also selling Korea. Okay.
Right.
So let's not.
No, it's almost, but there it's more technical. The selling is.
But this is also technical.
Yeah.
Large part of the outflows are passive. It's because the weight is falling, because India is underperforming. And every single day, India underperforms, the weight falls, and passives have to adjust their index, in their position to match the index weight.
So the flow bit, it's not active, discretionary kind of reallocation, that kind of thing, or that has already happened.
There is that also, but there's a fair bit of passive in this. So it has got a circularity to it. The opposite of this was happening in 2024, which is why India's valuations got stretched. And now it's going the other way, and that's why it's getting depressed. And these, the passive thing has, gained share globally in total assets under management and is a dominant, dominant price mover. And is not actually going to react to valuations. Is not going to react to relative growth opportunity.
Yeah.
It's in the active bit, but the active bit has lost share. So that is, I think, part of the problem. Just going back to the FPI question, of course, relative growth needs to get fixed, or we can have corporate issuances. But I think we can also do adjustments on the policy front.
I was coming to that.
So, for example, I think make it easier for foreigners to participate. And that is, I think, something that, should be done over the next few months, because it takes a lot of time for people to get registered. If I want to trade a US stock, I just have to go to one of the brokers' website, register myself, and I'm up for trading in 5 minutes. That ease of trading that market.
I remember at the CNBC-TV18 forum, the SEBI chairman was there, and I think you and others made that point to him, that the time to registration, the time when you come in, put the application in, and when you're able to participate, that was very, very long, and we got that feedback as well. But that is still an issue? That is still a niggle?
So, for example, in the budget, we increased the limit for non-residents, which includes non-Indians, to buy up to 24%. But they still have to go through a process which makes it rather hard for them to actually participate easily. Sure. It's not like a decision I make today, I want to buy Indian stocks and I'm up and ready for trading this morning. I can't take a decision at 8 o'clock in the morning to trade at 9:15. If I'm sitting outside India without an approval, And that, I think, can change, and it can become a lot easier. I know there are concerns around round-tripping, etc., but I think there is room for us to make it easier. On the debt side, there's room for us to reconsider withholding tax, because debt investors don't do it. And debt investors surprisingly have stood. They've not exited. They've actually been buying, and this is despite the losses they are suffering on the currency.
What about taxation, equities taxation?
So taxation, I don't think is a burning issue in my view. The issue about taxation is the whole administrative process to file returns and to pay the tax. It's not about the tax itself. And it reminds me of what my father told me in the 80s when I was first filing my tax returns for the first time. I was still a teenager filing my tax returns, and I was complaining to him, Dad, tax okay, I have to now pay tax. So he said, Beta, you made money, na? So that is why you're paying tax. So never be unhappy about paying tax. The fact is that, a lot of foreigners who probably are not making money now and selling, and so they're not paying the tax, right? So I think tax is not such a burning issue. The administrative process around that could be. Yeah, but I think easier access is probably the better thing. If you want to choose amongst policies, and I think that's the easier thing to fix. Also, capital gains tax, it can be a tricky thing. You can't do it retrospectively now.
Correct.
Because if you do it, suppose hypothetically you reduce long-term capital gains tax to zero, it's going to be a selling avalanche. Because now I can take all my gains without paying tax. Who knows
on
where
the stock of investments that you have?
Exactly. Who knows where the tax will be in 3-4 years? So it can't be done retrospectively. It can only be done prospectively, if at all.
Yeah.
Okay, interesting chat there, and we'll keep coming back to you with more from Morgan Stanley. For now, we need to slip into a break. Before that, let me quickly tell you the interactions that are lined up on the show. So first up, 8:35, ICICI Securities Probal Sen will put the spotlight on oil imports and more. 9 a.m. Jay Kali of Elara Capital will talk about the auto sector. 9:20, Vikas Khemani of Carnelian Asset Management will be our market master for the day. Following that, 9:30, we will chat with Amish Shah of BofA Global Research as they wrap up their conference. 9:50, the management of CMR Green Technology joins in as their IPO opens for subscription today. And towards the end of the show, Lata will speak to Amol Gupte of Citi ahead of their investor conference on the mood of the foreign investors. All right, get into a quick break. On the other side, we'll talk about the top stocks to watch for the day. Stay tuned. Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Vinny is now joining in with the list of stocks that you need to know for the day. Hi, Vinny. Good morning.
Hi, good morning. So first up, let's talk about NHPC, right? Yesterday we saw a fall coming in. It was the first day in terms for the OFS that had opened up. For the non-retail investors, they saw a very strong response coming in there, 3.47 times subscribed by the non-retail investors. The government has now decided to obviously exercise that green shoe option that they have as well. And the retail investors and employees will get to bid today. That's 3rd of June. Now, so we'll expect some bit of a green here, given that we've seen a fall coming in yesterday in terms of the stock and the strong response that you've seen. Now, we have John Cockerill that is also going to be in focus after the company has received an order of around 1,250 crores to 1,300 crores. This is from JSW Vijayanagar Metallics for a CRNO project. So watch out for this one. Concord Biotech, that also isn't going to be in focus after the company has received a US FDA approval for a drug that is used in treating organ rejection during transplant. The estimated market size of this is around $30 million. So that will be something positive that comes in for Concord Biotech. Bliss GVS Pharma, that's also something that will see some bit of a green on the screen. And the company's Palghar unit has received an inspection closure report from the World Health Organization. This is confirmed, and the positive responses they've gotten is in terms of good manufacturing practice. That has been confirmed for this plant as well. Lastly, Adani Ports is something that we'll see green on the screen as well. The May traffic data has come in, which has grown by 16%, led by containers as well as liquid cargoes. The cargo volumes overall were up by 15%, while on the flip side, you have the logistic railway volumes, which were down by 19%. Now, Nomura sees EBITDA CAGR growth of 19% over FY26 to FY28. Jefferies has also maintained the buy call and raised the target price as well. So we'll watch out for all these stocks in the trading session today.
Got it. Okay, all right. Thanks a lot, Vinny, for taking us through that need list. Well, let's hop across to Manisha Gupta. She joins us to tell us what else going on in the commodity markets overnight. Manisha, good morning. Plenty going on, I guess so.
It is, Nigel, yes. Pardon me. The crude oil prices is what I'll begin with because we've seen strong gains come in for this one. Now almost $97, $98 a barrel is back. Then there are reports of Iran firing missiles at Kuwait and Bahrain. The diplomatic talks between Iran and the U.S. are showing little progress. And then when you look at the U.S. crude inventories, well, they have declined for a sixth weekly decline. Also, the actual physical molecules of jet fuel and diesel are trapped behind the blockade. And there are more and more voices now suggesting that if the Strait of Hormuz continues to be shut by June and July as well, and with the summer demand season coming back, you could be looking at a massive shock in sense of crude oil prices on the higher side. That is what the street is preparing for. We also have seen gains continue for the metal prices. So whether it's copper trading at a 2-week highs or aluminum holding its 4-year highs has been extending gains. What is extending losses, though, has been the gold and silver prices, both of them trading in the negative and down by nearly 2% already for the month of June.
Thank you very much for that. Manisha, we will get into break. On the other side, we'll connect with ICICI Securities Probal Sen to put the spotlight on oil imports and more.
Welcome back. You're tuned in to Bazaar Morning Call. Well, the International Energy Agency head Fateh Birol has warned that the oil market could enter a red zone if the Strait of Hormuz does not open up unconditionally by June. An exclusive conversation with Shireen Ban, Birol said that oil markets will continue to be rocky and volatile even after the war ends. When asked if the IAE was considering releasing another tranche of emergency release, he said that not yet. Let's listen in.
I think it is rather naive to expect that the Qatar LNG terminals will go back very quickly where they were just before the war. So if it is, to sum up, if the Hormuz Strait is open, if there is a peace, it is an agreement, it will be rather naive to think that the next day everything will go back where they were before the war. It will be a rocky process, volatile markets for some time to come. This 400 million barrels is big, but it is only 20% of the reserves we have. 80% is still in the pocket. And we will see, we will assess the market conditions, and if we think it is necessary, we will be ready to act immediately. Now, I don't think that we are at this stage yet, but we are monitoring the markets momentarily and very closely. If we believe it is the time, we will definitely go for it. But at the moment, we are not there. If we are not able to see fully an unconditional open of Strait of Hormuz by end of June, July and August, the travel season around the world in many countries are starting. The flights and the cars and the buses, we may be entering the red zone for the global economy, especially those in Asia.
Well, that is Fateh Birol for us. For today, crude prices have risen to about $97 per barrel, and that is a bit of a problem. Probal Sen, oil and gas analyst at ICICI Securities, is now joining in. Probal, thank you very much for joining in. Every time we speak, we were hopeful that perhaps the conflict's going to come to an end, but it hasn't. So just yesterday, there was news about how India has started importing from Venezuela, and it now contributes about 10% of India's total crude imports. How significant is that? What is the price at which we are importing from Venezuela? And what would India's fuel basket now cost?
Okay, so first of all, in terms of how significant is it, obviously it's a fairly large number. If we look at the situation when the sanctions by the US were actually imposed, on Venezuela. Even before that, similar numbers, if slightly lower numbers, were actually being imported from this country by Indian players. Specifically, I think Reliance definitely, because of the complexity and its ability to process these crudes, was the largest buyer. And I think that situation has returned right now. So it does act as a useful buffer for meeting the shortfalls that we are facing in terms of overall crude availability. In addition to that, US imports from Brazil, imports from Africa, those all have actually ramped up. But from on the basis of reports that we see in Q1, we are still running short of around 10 to 12% of what our pre-war import levels used to be. Again, that's something that we'll have to verify from the companies, but that is what we see in terms of news reports. In terms of pricing, our understanding is that the Brent plus $15 to $20 premium that was prevailing in the peak period in March and parts of April, when the shortfall was particularly acute and prices were very, very strong, that has come off a bit to Brent plus less than $10 premium, but it does remain more expensive than it was compared to earlier benchmarks. So the Indian basket of crude is not really what is the price at which physical crudes are being delivered at this point of time. It is Brent plus a premium of anywhere between $7 to $10 from what we understand as of now. Individual crude pricing, it's going to be very difficult to understand or calculate at this time, but that seems to be the blended cost of delivered crude.
But when we get from Russia and now even Venezuela, is it at a cheaper price, or is it just acting as an alternate source of supply to secure the supply?
I don't think there is any cheap crude available in the market right now. I think it's unlikely that anybody is offering any discount on crude that is available to be purchased. It's more about just backstopping the shortages that continue from the Gulf region, from the Strait of Hormuz. Before the conflict, about 2.4 to 2.5 million barrels a day of supply was actually coming through from that region to India, with overall imports being about 5.2 to 5.3 million barrels of oil per day. So, obviously that's a big shortfall. We don't know how much is the net amount that is still flowing through the alternate east-west pipeline along with the Fujairah route from the UAE. And therefore, whatever shortfall is there, every source is being leveraged and tapped to meet this, but no discounts are available as far as we can understand.
All right. And Prabal, just give us the brief number. How much comes in from Russia as well as Venezuela out of the total basket?
From what we understand, 30 to 35% of our requirement, around 4.5 to 4.6 million barrels a day, is what is being imported by the country, of which close to 35%, I think, is coming in from Russia. Venezuela, as we just discussed, about 4.4 million barrels a day is now flowing from there. So that's close to 10%, 9 to 10% of what our requirement is. And then the rest, even US is a major supplier now. There are some crudes coming through from Brazil as well as African crudes. And as I said, some volumes are still flowing through from the Middle East, although it's a fraction of what it was pre-conflict.
All right. Prabal, then how do you approach these stocks? What do you think with regard to the OMCs? I think 7.5 rupees price hike has been pushed through. They're still making losses. But, the hope is that this war is called off and we see some kind of cooling off in terms of crude. So in your matrix, what are you factoring in first in terms of crude oil prices? And how would you approach the producers as well as the OMCs? I mean, what's your preference right now?
So we would, I think the IEA commentary just at the beginning of this session was fairly spot on, that this is not a binary situation where if the ceasefire is announced, the strait starts flowing normally from the next day. The fact of the matter is that there's a structural change in the way that the energy dynamics and energy supply chains will work, at least for the next 6 to 12 months. And therefore, we continue to believe that even if there is a ceasefire that is reached in short order, crude will remain elevated at around $85 to $90 kind of a range, which is what we are working with. And therefore, our estimates still suggest that, there could be significant losses in the first half of the year, particularly if you see the LPG losses, which have actually risen very, very sharply. They were less than 100 rupees a cylinder. The commentary given by the OMCs themselves suggested that in May, they have reached upwards of around 600 rupees a cylinder. So if you factor the LPG losses alongside still the retail losses, even though the extent has reduced quite a bit. Our sense is that H1 will see OMC earnings remain under pressure. And therefore, upstream will probably continue to do better. Now that the crude prices are in a slightly narrower range, ironically enough, the threat of any or even the risk of any windfall taxes seems to have reduced in the sense that, we don't see any commentary, and even the ONGC and oil were very clear in saying that there's been no communication to that effect. So what you're looking at is probably 2 quarters of extremely strong earnings from upstream and 2 quarters of very soft earnings, if not losses, from OMCs in the current environment.
Okay, so just some follow-up questions. So on oil marketing companies, you said the LPG losses are about 600 and per cylinder. And for auto fuel, what is the loss that we're working with right now after the price hike that's taken place? And therefore, as things currently stand, assuming it continues status quo, what would be the losses in Q1 for OMCs?
I don't have the exact numbers of Q1 in front of me. We have not released our preview, so it'll be difficult to share exact numbers. But retail margins at this point of time are still, low single-digit losses are still there for petrol, and similar levels would be there for diesel. The reason why it's difficult to pin an exact number is that there is a negotiated pricing that is now being used from what we understand. There were news reports earlier that there was an RTP capping that was there at a certain level. Although that capping number is not publicly available, our understanding is that refineries are not really transferring it at the exact international prices to the OMC marketing, whether it's from the internal refining or from the external refiners who are selling to the OMCs. So everybody's margin number will be different, but if you apply a certain, a cap of anywhere between, let's say, $15 to $20 product spreads on what the international prices are, you would still come to a small loss on the retail front, even in Q1.
Prabal, any word on the refiners? MRPL, CPCL. CPCL, I mean, just take a look at that stock. The markets are in a bit of a tizzy, but that one's making fresh highs. I think it's 1,150. They've been repaying their debt. There was an argument that replacement cost, in fact, is far higher than what it trades at in terms of an EV. Any view on these names? Because global refining capacity has got hit.
Yeah, I think I wouldn't be able to comment on CPCL since we don't cover it. But in terms of refining margins, you're absolutely right that the fact is that, significant amount of refining capacity continues to be impaired, both in the Gulf as well as in other regions because of the fact that the economics was not working, crude availability was an issue. So depending on which estimates you look at, anywhere between 2 to 3 million barrels a day of refining capacity continues to be constrained. And that is reflecting in the fact that product spreads continue to be fairly strong across products, specifically petrol and diesel, which are, as well as ATF, which are the mainstay of product yields for Indian refiners. If you look at the product yield or distillate yield that is there for most Indian refiners, these 3 products alone will be close to 65%. And these are the 3 products that have been doing that have been showing the most strength as far as product spreads is concerned. So definitely, I think if refiners are allowed to earn the unconstrained refining margins, I think earnings would look fairly strong for them.
Okay, very short since we're out of time, Prabal, but one high conviction idea from you.
I would probably look at ONGC in the current environment. I think that valuations are still fairly attractive. Production growth should start to pick up over FY27 and 28 based on all that they're doing with respect to KG, Daman Offshore, as well as the technical service arrangement at Western Offshore. And earnings, as I said, will get a boost from the way that crude has been behaving. And, even if they get around $80, even that implies a 20-25% uptick for the stock from here.
Okay, thank you very much for that, Prabal. Always great chatting with you. We will get into a quick break. On the other side, we'll connect with Devin Choksi. Stay tuned for that fundamental stock talk.
Welcome back. Well, Gift Nifty is suggesting a pullback of close to around 200 points approximately, and Asian markets actually a little bit mixed. Some of them were closed, so they've reopened. For the time, actually, Gift Nifty is, beg your pardon, it's suggesting a 120 to 130 point downtick. Remember, yesterday we saw a bit of a relief rally, but if we're going to see 130 point downtick, then most of what we put on yesterday is going to get sold in two. So we'll have to see how that goes. But keep in mind, in the past, this 23,250 has been actually a bit of a lucky level for the bulls, and risk reward has favored the bulls. So they'll be hoping for more of the same. We'll wait by for the opening. For the time being, Harmaz joins us. He's going to tell us some of the big movers yesterday. Some of them were backed by delivery. Harmaz, morning.
Morning, Nigel. And NHPC, of course, is a news-based move in yesterday's session at the OFS that was launched. The stock ended 7% lower, the biggest single-day fall and volumes since June of 2024. But unlike Coal India, which also received a very strong response to the non-retail portion, NHPC did not recover from the lows of the day. It, in fact, ended at the day's low. And the volumes on Tuesday also the same, the highest since June of 24. 21 crore shares were traded yesterday. The 20-day average is 1.5 crore, and 44% of those shares were marked for delivery. So over 9 crore shares were marked for delivery. The 20-day average is only 70 lakh shares, and the stock is down around about 25% from its 52-week high levels. And now the three IT names that I'll be mentioning, it shows you the extent of the selling pressure that these names have seen. Infosys saw its biggest single-day gain since May of 25. It was the most traded stock on the Nifty 500 yesterday. Volumes were 3x its 20-day average, barring that MSCI session on Friday. 60% of those shares traded yesterday were marked for delivery, 2 crore shares that is, and that too is 3.5 times its 20-day average. And despite this move, the stock is still down 22% for the year. TCS saw its biggest single-day gain since July of 24. It was the fourth most traded stock on the Nifty 500 yesterday. It was only the fourth instance in the last 3 months where over 1 crore shares were traded on the stock, and 52% of those were marked for delivery. The delivery volumes too were 3x its 20-day average, and this stock too is down around 26% for the year. And Newgen Software being the last one, it was the biggest single day gain on record for that stock, was up almost 20%. The stock over 3.5 crore shares were traded yesterday on Newgen Software. The 20-day average is only 8.5 lakh shares, and only 8% of those shares were marked for delivery. So around 27 lakh shares. The 20-day average is only 2.5 lakh shares. Now the stock is down 36% so far this year, and from its peak or around its 52-week high, which is around about 1350, the stock is down well over 60%.
Got it. Okay. All right. Thanks a lot, Harmaz, for that. Well, let's welcome Devin Choksi, MD DR Choksi Finser, who joins us on the show. Hi, Devin. Good morning. Good to see you, Vin. What about tech, Devin? 28,500. I recall the index was around those mark or a little lower than that. And suddenly the tech index has moved to 31,000. And stocks have popped up 10-15%. But keep in mind, they're more than 15-20% away from their 52-week highs. What's your view on tech? I ask you this because some of those ADRs, well, they ended lower overnight. You've had some of those services-based companies, the SaaS companies, that also saw profit taking. Would you buy into this dip? Do you think the correction got overdone, or do you think it's run its course and now you'll stay away?
Yes, Nigel, good morning. Certainly, I think we have been vocal about it, that the tech companies, they remain absolutely convincing from the business perspective as well. Most of the Indian IT companies, they being the service providers and adapting to the AI way of delivery is actually, I think, shifting away from the time and effort basis of the revenue model to outcome-based revenue model. That's what I think we have been understanding on these companies. And that's where we felt that the downside in the stock prices is practically limited. The movement right now, as we are seeing, maybe I think due to 2 or 3 reasons. One, of course, I think the downside is limited. So obviously the fund investors find it more meaningful to accumulate more amount of IT stocks in the portfolio, especially given the kind of inflow of money that they are having. On the other side, I think what we are observing, majority of the large investors, they basically feel at this point of time to, I think, buy into some of the mid-tier IT companies. And that's where probably, I think we see the opportunity in some of the likes of Tata Technology or KPIT or Tata Elxsi kind of companies, where I think their OEM customers have actually placed significantly large orders, and they have a fairly good visibility on execution side as well. So yes, I think we see the large cap IT companies, the contra buying happening because of the downside risk limited. And at the same time, I think mid-tier IT companies where the larger growth is lying because of the higher execution part, I think that they are doing it. So certainly our views validated as far as IT is concerned, and we remain firm about this view. We believe that I think there is 15 to 20% upside in this counter, some of these counters going forward as well.
Okay, all right. And what about any of these product companies you like? Yesterday, I think stocks like Newgen were up more than 15%. Orient Pro as well was up close to around 8%. Will you be looking at these companies? HP, we know what it did overnight, was up close to around 20%. If any view on these stocks are half from the top.
So our major focus has been on likes of KPITs, TTS, and Tata Technology kind of companies, where I think they are firmly integrated into their OEMs program and providing the solutions, which are basically the productized solution, as you may want to call it, as for their end customers. We like these companies also because of the fact that there is a fairly good visibility of next 2 to 3 years in their execution program. So that's why we believe that I think these are a little better off compared to pure product companies.
Okay, all right. Let's take a look at the bottom of your screen, Lenskart. There's a large trade that's got cleared out, close to 5 crore shares getting cleared out. So keep an eye out later today when you look at the FI, DI flows as well. Could be a little bit skewed because of that. Devan, any view on this one? Lenskart. Everyone was looking at it through a closer lens, but the stock has done a thing of its own. After seeing, I think, a gap down 10% downtick, I think, on the day of listing, from the 350, 370 mark, it's at 520. The numbers, to be fair, have actually improved. You could argue on the valuations, but numbers for the past quarter look pretty good.
Yeah, I think they're supposedly better, and definitely I think we would expect it to remain better going forward as well. Because the pure focus is shifting onto the profits. I think that is an important part of the entire transition which we are seeing in this company. How much I think it is in price, I think a guesswork, because frankly, to me, I think this market capitalization is definitely suggesting that I think they require significantly large amount of profit to build to justify this market cap. Not too sure whether I think one could immediately buy for deep value investing. Maybe momentum investing, definitely for sure. I think you can argue for going in for this company.
Got it. All right. Devan, wanted your view on NMDC because that stock has moved beautifully in the last few days. And, I understand that effective today, they've gone ahead and effective another price hike. On lumps, it's up by close to 200 rupees. And on fines, it's 150 rupees higher, which is great news from NMDC's perspective, and for the users, they'll have to pay a little bit more. The revised prices on lumps are around 5,700 rupees and on fines 4,850 rupees odd. That's a rough information I've got based on the sources. We'll wait for an official release on the exchanges, but ballpark, this should be the rough increase that we should see. And remember, when we quote these rates, they are for the Bailadila mine, which is the Chhattisgarh mine, and that's what they report as well. It's a bit of a surprise hike, right? Because they've already increased prices in the last few months. I think from January onwards, we've seen prices move up by close to around $1,000 or thereabouts. And it's a little bit of a surprise because it's ahead of monsoon, right? I mean, monsoon is upon us, and hopefully we'll see monsoons pick up from an economy perspective. But ahead of that, you normally don't see, these sort of price hikes, but that's coming. And also international iron ore prices have weakened a little bit. So a bit of a surprise package coming in for NMDC. And as is, the stock has been quite strong. Devan, in your view, NMDC at around 95 rupees. The last few days, the numbers are a little bit softer because of the pellet business delivered a bit of a loss. Then the production number for the past month wasn't good. But now we have positive news flow. I don't know whether the reaction will be positive because to negative news flow, the reaction was positive. Your take.
So this quarter, April to June quarter of the financial year 26-27 looks, I think, pretty set for this company to report volume-led higher numbers, largely because of the fact, even if you see the last results, the amount of production that they have increased has been quite significant. Fully understood that I think in this quarter, the dispatches are on a higher side, and that's what the confirmation we are getting. So despite of some amount of weakness in the international prices, I think you are still seeing a higher amount of demand continuing for the iron ore. And that's where probably I think you're likely to see a large number of profit reported in this quarter. According to me, I think the market has moved up by 10 rupees in this stock, I think in the last 2-3 days, is largely because of the fact that the April to June quarter is expected to be the bumper quarter as far as the profits are concerned.
Devin, where do you stand on this solar theme? There are a lot of naysayers because they say that there's oversupply, returns are not very high or a little risky. But this is a theme which has done well. And I was just reading a JM Financial, and they're saying because there's ALMM list 2, which comes out in June. After that, in June 28, ALMM 3, list 3 comes out, basically forcing backward integration and helping some of the big companies. So the pecking order that JM Financial has given is MV over Premier, Premier over Vari, that over Vikram Solar. So you've got 4 companies in this place. Do you have a view on the solar theme, and which one would you back?
So on a business side, Rima, I think we remain fully convinced that I think the business is going to grow well. Now, whether any of these companies deserve immediate upside, I'm not too sure, because I think most of this is already priced into the stock. Unless likes of value are basically fully getting backward integrated, that's where we see, I think, higher amount of opportunity and a scope. The stock has been moving in the range for a while, and in my viewpoint, I think stock price correction is a good opportunity to consider it again, because it's completely backward integrating on an end-to-end basis, starting from polysilicon onwards to supplying of the panel and implementation as well, along with, I think, the other areas of activity like energy storage and green hydrogen. So all in all, together, it is becoming an integrated play, and that's why we like this company better compared to others.
Okay, all right. Devin, I wanted to ask you about one more stock, IFL Finance. You know, the stock has been a rank underperformer, and there's been a large seller on the counter, which has been the technical factor that's been weighing down. Now, I understand that, if you look at the exchange releases, gradually that's getting absorbed. And yesterday, the stock saw a bit of a recovery. After such a stark underperformance, will you be interested at around that 480 rupees odd?
Honestly, Nigel, not seen enough, I think, in this company. So we'll refrain from putting any view at this point of time.
Okay, no worries. Got that. Devin, request you to stay with us. For the time being, we'll slip into a short break. We'll be back pre-opened rates. We'll also be joined by Jay Kale of Elara Capital, who will be focusing on the auto space. We'll also be joined by our technical experts. Sudarshan and Somil are waiting for us.
Welcome back. This is Open Exchange coming to you live from the CNBC-TV18 Motilal Oswal studio. This morning, the GIFT Nifty is suggesting a gap down opening, a cut of about 130 odd points. But remember, yesterday we had a very smart recovery. The Nifty at open was down about 200 points and ultimately ended with a gain of over 100 odd points. But crude prices are negative. Asia, we should pull up the Asian markets, and they're chugging along just fine. So that AI momentum continues to pull most of the other Asian markets higher in trade. Hang Seng has given up a bit, but that was the outlier yesterday. But if you look at Taiwan, you look at Korea, the gains are very much intact over there. But let's talk about levels. Sudarshan Sukhani, Somil Mehta now join in for some technical trading ideas. Sudarshan, would you give a lot of importance to that intraday pullback that we had yesterday? Was it on account of the weekly expiry? And what's the trade now? Yesterday you said it was sort of in a no trade zone. What is your view today?
Good morning. My view is the same. See, the markets will make an attempt to find some kind of a low, start building a base. We don't have to wait for a long period for that base building process, but we must get some signs before we can start becoming bullish and go long. This is not a market where we can go short. Any news event can see a 300 to 500 point rally on the upside and kill short sellers. The only trade that will be available is once this decline ends, then we are willing buyers. But it's too early to say that decline has ended. One level that we should be watching out for is the 23,250, 23,300 zone, that 50-point band. If that band holds either today or tomorrow, then something interesting on the long side will emerge. Today, we just want to watch that level.
Got that. Somil, you want to come in on the Nifty? Yesterday, we managed to hold on to important support levels of 23,220. Where from here on, if there is a gap down, what's the advice on the Nifty?
Yeah, at this point of time, good morning. Good morning to everyone. See, Nifty has been making lower tops, lower bottom on the weekly charts. every time in the last 4 to 5 weeks, every time it has made lower tops and lower bottom. Now this time Nifty has taken resistance around 24,100, and it has again started moving below the moving averages, short-term moving averages, which is 20 and 40 daily moving average, and it is breaking the previous swing low as well. So from here, the trend is still down. I'll be expecting more downside till 23,100. Probably if it does not sustain around 23,100, then probably 22,700. I would like to go short on weaker stocks, which are trading below 200 daily moving average, trading below 2040 daily moving average, and already in the downtrend. So I'm looking for weaker stocks to go short. But yes, of course, there are pockets where we are seeing good, move up, which is IT, pharma. These sectors are looking definitely good. So I don't suggest a short there, but yes, there are, pockets where you can go short.
Got it. Okay, all right. Hi, gentlemen. Morning. Good to see you all in. Sudarshan, let me come across to you. What are the top stocks you're looking at?
Well, it's a mix, and CAMS is a buy with a stop under 760. Keynes is a buying opportunity with a stop under 3115, 3115. Ashok Leyland is a sell with a stop above 155, and Voltas is a sell with a stop above 1265. It's a mix, and that reflects the market also.
Got it. Okay. Somil, what about you?
I'll be going short on a few stocks. One is REC Limited. REC Limited already in the downtrend, taking resistance at crucial resistance levels, trading below short-term averages, that is 20 and 40, trading below 200 daily moving average. My stop loss would be 332, and my target would be 305. The second stock is SBI Life. Already in the downtrend, taking resistance at the averages, has broken a triangular pattern on the downside. So my target would be around 1700, and my stop loss would be 1855.
Thank you very much for that. Those are some technical trading ideas. Today also the 3-day RBI MPC meets starts from today, 3rd to 5th. The decision will be only known on 5th. That's Friday at 10 o'clock. Perhaps no tinkering on the rate side, but the outlook on inflation growth will be very crucial in light of the fact that the West Asia crisis continues to simmer on. But let's talk about autos. Jay Kale, Executive Vice President Research, Elara Capital, is now joining here with us in the studio. Jay, it's so good to have you here with us in the studio.
Yeah, good morning and great to be here. Thanks for having me here.
All right, so let's begin top down. The Q4 earnings season, the key takeaways, and that with the fact that we got the May auto sales numbers. What's the read on the auto sector from here on?
Yeah, so I think if you see the numbers in Q4 have been pretty good. Most of the companies reported in line to marginally above estimate numbers. The commentary was also pretty buoyant from a demand trajectory side. If you see passenger vehicle players, most of them kind of guided 10% plus growth. Two-wheelers was single-digit growth guidance. CVs was a little cautious. But one needs to see what happens from now, because all of these numbers and commentary was before the fuel price hike. Till then, the buoyancy was there in terms of demand. But of course, now one needs to see the way forward once this fuel price increases happened. Current numbers seem to be good, but there will be some slowdown imminent going forward.
Okay, all right. Let's take it piece by piece then. Jayan, good to have you in the studio. The passenger vehicle segment. You had a couple of stocks that have done very, very well. But now, what's on your pecking list? And for the industry, what kind of growth are you factoring in for FY27? Some of the street believe that maybe these OEMs are being a little bit too ambitious. Right. You're in that camp, or you believe that they'll walk the talk?
So I think if you see, everyone's given growth guidance. Most of them have given growth guidance for themselves. So obviously, most OEMs expect market share gains for themselves. Our current industry growth assumption is 6 to 7% for FY27. If you see, till now, they've clocked double-digit growth. May has been pretty good. Also got to do with some bit of pre-buy because there are some price increases coming in June. Point is that with this inflationary pressures that we've seen in the last few days, you will see some bit of a slowdown. But the question is, a key question in minds of investors is this a slowdown or is this a start of a down cycle? In our view, this is more of a slowdown, not necessarily a start of a down cycle, because there are other positive metrics also that have happened in the last 8 months, which should hold in good stead in terms of resilience of demand, which we are already seeing currently.
Okay. You've written a recent report which talks about the two cycles and the parallels after F518 and H1 of F519. Take us through what's happening and what we can draw from the lessons of the past and how it's going to play out.
Yeah, so like I said, the key question is that with all these fuel price increases that we've seen, could this be a slowdown or could this be a start of a down cycle? Now, we draw parallels to what happened in the FY20 down cycle, and this is even before BS6 increase and pre-COVID. Actually, autos started declining in FY20 in terms of retails even before COVID hit, right? And that was got to do with one NBFC crisis, the fuel price increases that had happened, the insurance increase that we had seen. All of that meant that during 2H FY19 and FY20, the total cost of ownership for PV and two-wheelers actually increased by 4 to 6%. Okay. Right now, if we draw parallels to that currently, here also we've seen that we came across a very good growth in 2H FY26, and then of course these inflationary pressures are starting to hit. But if we see to this time around, the total cost of ownership, even after these increases, is still 1 to 4% below pre-GST levels. So we still have that cushion, and hence probably the down cycle may not be triggered in this cycle versus what we saw in FY19-20 time frame.
So you'll be reasonably more optimistic on both the two-wheelers as well as the passenger vehicles, what you're saying. Tell us, what about CVs?
Yeah, so I think
some on the street, they were talking about this, fresh trend emerging a few months ago on CVs, and to be fair, that has, pretty much played out. I mean, I think there has been a bit of recovery out there. But would you be a little bit cautious on CVs? Yeah.
The CVs is one of the most cyclical industry, right? If you see till April to November, things weren't really that buoyant, and then December to March, we suddenly see a huge spurt in volumes, and that triggered that probably this cycle will last longer. But here we have to see that the tonnage has already crossed pre-FY19 levels. So we're already sitting at peak tonnage, and from here, if diesel prices the way they are going up, fleet operator profitability becomes a question. And the key driver of demand in the last few months was replacement demand. Yes. With fleet operator profitability coming under some question, they will be a little cautious in replacing their demand, and they'll probably chug along with their old fleet as well. So to that extent, we are a little more cautious on CVs. PVs and two-wheelers are much more resilient. Historical cycles have shown that PV and two-wheelers cycles are not sharp. CVs are pretty sharp. Risk reward from here, in our view, is better for PV and two-wheelers over CVs.
Well, you put out a couple of scenarios, right?
Yeah. So what we're saying is that if at all, in a worst-case scenario, the down cycle like FY20 happens this time around, what are the kind of downsides we can see for the different segments? For stock price downside from here for PV and two-wheeler names, in a worst-case scenario, could be 10 to 20%. But for CVs, even after the recent correction, could be 30 to 40%. Whereas the base and bull case upsides for PV and two-wheeler names are close to 20 to 80%, whereas for CVs is just about 10 to 50%. So risk reward, if I have to look at from here, much more favorable for PV and two-wheelers than CVs.
Do you think EV is at an inflection point, and can supply keep up with the kind of demand we're seeing in the market, or will that be a bottleneck for strong growth?
No, absolutely. I think EVs, if you see post-Feb March, have seen very strong demand on ground, and we are seeing capacity constraints being seen. However, I'd like to point out that 1 year back, EV penetration was kind of undershooting the earlier expectation, which now is actually kind of probably FY30 estimates of EV penetration of 20% for two-wheelers and 15% for passenger vehicles now looks more realistic given the recent scenario. I think for the next few months, it will be a capacity ramp-up mode for PV and two-wheeler names on the EV side. And I think EV penetration is surely expected to increase further from here. The buoyancy on ground, the customer sentiment is definitely more positive on EVs now than 3 months back.
We can't let you go without giving us your top picks. Since you like PVs as well as the two-wheelers, what's top of the list out there?
So within our top picks, we have Eicher Motors, TVS, Maruti and Mahindra. We prefer in this expected slowdown kind of a scenario, companies which are expected to gain market share, like Eicher and TVS, are expected to fare better, and valuations will be much more supportive for them.
And one auto ancillary stock that you would bet on?
I think I'll give a name. I have 4 top picks over there. Gabriel, Minda Corp, Uno Minda and Sona BLW. These 4 would be the top 4 auto hanks over there.
Jay, great to have you here with us. Look forward to the next conversation, and keep coming down here to, with us to chat face to face.
Surely, it was a pleasure. Thanks for having me here.
Okay, it's about 9:10. The pre-opening rates have settled in, and it's a downtick of about 67 points. Sensex lower by 140 points. So mildly lower after the big up move that we had yesterday. Sudarshan is back with us for his 9:10 call. Sudarshan?
It's camps, buy camps with a stop under 760.
Okay, now let's go across to our Sudarshan for some brokerage calls of the day. Sudarshan?
So first one is on pipe companies. JP Morgan maintains overweight call on Astral with a target price of 1,800 rupees per share. Same overweight call on Supreme Industries, and here target price is 4,050 rupees per share. It says the top 5 companies combined saw 8% YOY volume growth in FY26 with substantial market share gains by both Astral and Supreme Industries. And these two companies have delivered volume growth of 16%, 14% respectively versus flat for rest 3 companies combined. So it expects share gains for these two companies to continue in FY27, and these two companies can continue to report double-digit volume growth even if industry sees muted growth in FY27. Next one is Titagar. Jefferies maintains buy call and target prices increased to 990 rupees per share. It has written the note after Q4 earnings in which EBITDA was 7% above estimates, which was driven by better than expected execution and margin. And also management has guided for substantial execution ramp up even in FY27. Company is going to be a key beneficiary of rising passenger metro coach demand led by government initiatives. And considering all these factors, Jefferies now estimates 44% FY26 30 EPS CAGR. Last one is car trade. Kotak Institutional Equities has upgraded the stock to buy, and target has been increased to 2,300 rupees per share. Stock has come off sharply Y2D on concerns of disruptions from AI models, but as per Kotak Institutional Equities, its deep dealer database and value-added offerings may limit the impact because of AI, but upgrade is on account of sharply higher valuations for OLX, and OLX has said that it targets steady GMV growth, improving monetization and margin, and Kotak has raised FY27-29 EPS estimates in the range of 1 to 5% on higher profitability estimates, especially for OLX.
Got it. Okay, all right. Thanks, Sudarshan, for that. Hopping across to Vinny. She's here with a note on Mankind Pharma. Vinny, you've got a bullish and bearish argument, I believe. Go ahead.
Absolutely. Hi, good morning. So first up, and for the bullish commentary that we have, that's coming from Jefferies. They're maintaining the buy rating, target price of around 3,000 rupees per share. Now, what are they positive on? Double-digit India growth. That should work out for the company going forward. That will drive the growth. And what in that will drive the growth? Acute therapies. That will do well. Strong volumes are expected, and which is already visible in FY26. Now, that is what they expect to continue as well. They're also expecting high teens export revenue growth coming in for the Bharat Serum vaccine side, which they've taken an acquisition as well. So that's why they're expecting stronger growth, and that would drive deeper market penetration and newer markets. That is also something that will add to the growth story. Over the medium to long term, what Jefferies highlights that they believe that the management will continue to invest in R&D, and that could help deliver strong growth. Now, on the bearish side, who's on the bear side? We have Bernstein, that is maintaining their underperform rating. Target price is 2,057 rupees per share. They believe that the go-to-market strategy engine as well as acute therapy conversion, slight bit of a weakening is something that they're expecting here for the company. R&D intensity, that is something that will remain. But versus other peers, it's still 1/3 of that. So versus other peers, they're still much lower in terms of the R&D spends that they've spoken about. And they believe that the move into super specialty, that's a bit of an abrupt move that has come in, and seems like that's a disconnect from the core therapies and core execution. That is something that they are worried about, and that is why they're maintaining their underperform rating on this one.
Thank you very much for that. Just awaiting the market opening. Asia before that, the Japanese markets have surged 2.5%. The Taiwanese markets at 1.9%. And Kospi as well will come up for you on your screen. Kospi is not trading today, but you can see some softness coming through in Hang Seng, even as the Chinese markets are up close to about 0.6%. Just awaiting the early rates. Friday was a difficult session for our markets. Monday, we continued with the downtick. Yesterday, we opened lower but managed to close higher as the Nifty weekly expiry led to some buying. The second half of the trading session was strong, and the Nifty inched closer to 23,500. The bell has rung. The opening tick on the Nifty is 23,420, a cut of about 50 points on the Nifty. The Sensex is lower by 250 points. In percentage terms, we're looking at a downtick of about 0.25%. So not too bad, but a little bit of a give back from yesterday's up move. What's on the way down are the IT names. They've been strong for the last 3 trading sessions. So today there is a pullback in that rebound trade. The Nifty IT index lower by 2.5%, with TCS selling off 3. Infosys down 2%. Wipro, HCL Tech also lower by 1.2%. Tech Mahindra has a downtick of 1%. And we should pull up LTI Mindtree, LTM, because the company held its analyst day yesterday and the company reiterated their aspiration to double revenues in 5 years and expand EBIT margins by 200 basis points. Again, this is the 5-year outlook shared by the company as a part of their Lakshya plans. And their key takeaway is that AI will shrink part of their revenues, but it will open up new opportunities, and therefore net enterprise tech spend, according to them, will expand by $1 trillion, and that's the opportunity they're going after. So IT is right at the bottom. Then you've got cuts coming through in Eternal, ITC, some NBFCs like Bajaj Finance, Shriram Finance, a weak. Asian Paints is under pressure, so that's down over 1%. Now we've seen an increase in crude prices, and along with that, Interglobe Aviation will also come up. On the way up, a few gainers. I can count 5 on the Nifty, led by Adani Ports, a Bharti Airtel, and an Apollo Hospital. But no Nifty stock, at least as of now in the opening tick, has a gain of more than 1%. Now the sell-off is accelerating. What started off as a 50-point downtick has now accelerated to 160 points lower on the Nifty, and the Nifty is now closer to 23,300. The key level to watch will be yesterday's intraday low, 23,220, which has acted as a support in the past as well.
Tricky times, Rima. You take a look at the tech index. Well, that's pullback itself. Yesterday it was the biggest gainer. Today it's the biggest loser. And you have tech stocks that are selling across the board. You know, if you look at the broader market, stocks like Forge, LTI, I think you have Persistent Systems, all of them down 3 to 4% in trade today. So big downtick is what we're seeing. Emphasis as well as down closer around 3% or thereabouts. From the frontline names, though, there are a few gainers because you have around 900 stocks that are still gaining. MTAR Tech, just take a look at that stock. It pulled back a little bit. It's resumed its winning ways. So big uptick is what you're seeing on MTAR Tech. Volume's fairly decent as well. Borosil, I think there's some protection that's coming in there. So that's why Borosil as well is up close around 4%. Good move is what you're seeing on Borosil. Concord Biotech, a favorable news flow coming in there. So that stock as well has moved up. Smart up move is what you're seeing out there. And Newgen Software, you know, that was a stock that moved up yesterday 15% on large volumes. It's a stock that's nearly halved, I think, from the top. But today as well, volume's quite high on that stock, so it's moving up. Sterlite continues its winning ways. That stock is up closer around 5%. Remember, yesterday, there was some supply that came. That's got lapped into. Another stock that I'm looking at very closely is Tejas Networks. Now, just take a look at that stock. That one, in fact, is up close to around 4% as we speak. This is a stock that had corrected from more than 1,100 rupees all the way to close to 300 rupees. And today it's moving with very, very good momentum. So keep an eye out on that one. NMDC, we told you about the price increase. It's rallied a goodish bit in the last few trading sessions. Today it's putting on some more weight because of the surprise price hike that we've seen. The Nifty has revisited the 23,300 odd mark. The past 1 month has indicated that at around 23,250 to around 23,300, you've seen a bit of a bounce. The bulls will latch on to that data point and hope that we see a bit of a bounce even in today's trading session. For the time being, it's a very, very nervous start. But maybe, in fact, the bulls will fancy their chances. For the time being, the Indian rupee as well as has opened up with some weakness. Falling through yesterday's weakness that we saw. The rupee yesterday ended at around 95.3, I think so. Let's pull up the Indian rupee. I think that showed some weakness to kickstart trade as well. Now down close to around 200 points. So clearly, it's a very, very weak start to the trading session, Rima.
Well, indeed. So those are some of the big movers. Just to go back to that point about LTM, that's LTI Mindtree, and we had some brokerage notes also coming through on them. So Jefferies has an underperformed rating. UBS has a neutral rating on LTM. So basically, you know, as I said, they had their analyst day yesterday, and what they gave, and this is important, they said the enterprise tech spend today is $1.3 trillion. Now, because of AI, the legacy business, we will see a compression of 20 to 25% of the current spend. So 20 to 25% of current 1.3 trillion, which is about 0.3 trillion. So we are looking at a net tech spend of $1 trillion.
Right.
But because of AI, 2 new opportunities are opening up. One is companies are looking to modernize their tech debt. So that is an opportunity. And secondly, even business AI services is opening up. So these two together, according to LTM, can add 1.3 trillion in terms of an opportunity. So therefore, what they're saying is You add the existing 1 trillion, which is net of the business compression because of AI, the two new opportunities of 1.3 trillion, we're looking at an enterprise spend of 2.3 trillion. So current 1.3 trillion, which is pre-compression, goes up to 2.3 trillion. And that is the opportunity for the Indian IT companies. Now, the question is whether they can execute on it. So brokerages is still not convinced. So UBS says that we will wait to see tangible signs of revenue acceleration before they turn constructive, because they have a neutral call on LTM. And what LTM also spoke about is that they see 200 basis points of margin expansion over the next 5 years, because some of these services are coming in at higher margins. But again, I think the proof will be in the pudding in terms of execution. But that is, one of the few companies talking about how this entire enterprise tech spend will change for IT services companies in terms of opportunity, in terms of compression. It was laid out by LTM. And just to reiterate, their 5-year goal is to double the revenues and expand margins by 200 basis points. But we've got Vikas Khemani, founder of Carnelian Asset Management, joining in. Because it's been very, very tough. All domestic institutional investors, retail, they've been so patient. They've been consistently putting money into the market month after month. But it's tested everyone's patience with the kind of moves that we've had in the market. What is your own assessment from here on? Do you think this is going to be another tough year where you should not expect anything in terms of returns? Because even if you go up from here, at best, perhaps you will have a flat year.
Morning. I think in the last 1.5 years, we have had one or after, setback at a, macro global level, started with, of course, in India, Operation Sindoor, then tariff, then, West Asia war. Beginning of this year, if you remember our conversation, we were very positive because corporate earnings were picking up, Indian economy was holding on. The West Asia war has created a concern, especially on the oil price and, of course, on pressure on the currency. So that has put some pressure. But again, I think these kind of events do happen in the markets, and which kind of derails the story from a short-term perspective. But we all know from the experience, whether it was Ukraine war of 22 or COVID year, that these kind of periods are the only period which are the best vintages to be built. And investing is never about a quick return. That's called trading. So according to us, and I understand that when you don't make money for 1.5 years, it feels bad. But at the same time, investing in long term gives you these kind of periods only give you the best outcomes. So we've been kind of our view is that once the West Asia war settles down, or especially the energy prices comes down, I think India's story should be back on track. I mean, still it is in some sense from other than this factor, pretty much the rest of the macro factors are working out, and thankfully. Domestic flows have held on to the markets, and this kind of situation, also markets have held well. Imagine, when things turn back, how the markets would behave. So according to me, we've been fully invested. Our idea is to kind of identify good companies which you think, can come out well on the other side. And we've seen this in the past. So that's our approach, throughout this period of crisis.
All right. Hi, Vikas. Good to see you. And Vikas, what kind of measures are you looking at? We're looking at the center, and we have now, I think, a 9-month period where there is no elections as well. So some good reform measures can be taken. Anything that you're looking at in particular?
Yeah, there's a possibility of some kind of, reworking on the capital gains situation. That's at least from the recent comment of FM. If that could be worked out, that would be good. According to me, keeping a point, equity market is in the interest of ability, having good equity capital, risk capital available for the economy, and tax collection anyway from capital gains is not a lot. So it's a good trade-off, in my opinion. Government can make out. But if it happens, it'll be great. If it doesn't happen, I think we have to keep working at what it is. So, and generally speaking, I think other than that, I would expect the government to continue to focus on investment boosting. How do we do import substitution? Because government is working at it, and there's no quick answer to that. One of the biggest problems is semiconductor imports, and that has put a big strain on our FX. Gold has put a very big strain on our FX. So any measures around that would be welcome, but there are no short-term answers adequately available. So I'm sure there will be some work happening there. But in general, I think continuing to execute more of same. How do you boost industry? How do you boost investments? Execution focus. Those are the important things.
There is a Adani Investor Day which is taking place today and tomorrow across Mumbai. So all the key Adani Group stocks will be presenting today. So whether it's Adani Enterprises, Adani Ports, Adani Green, and you can see buying in some of the names. So for instance, Adani Ports is up 1.3%. So maybe there is some excitement. The street is going to wait and watch to see what comes out of that. Because are you invested in foreign markets? Is that something you're looking at, or what percentage of your portfolio today would be in markets outside of India?
I think I do believe that India is one of the best sort of wealth creation story, not now in the shorter term, but even in over 5, 10, 15, 20-year period, we have seen from our experience. So, we think that, diversification should be done, global diversification should be done only with a purpose. So we don't think there's any significant merit from an objective to be achieved perspective. So everybody has. So we currently don't have any exposure to any global markets.
Okay, all right, Vikas. But what do you make of this entire AI theme that's playing out globally? We have missed out. It seems we have become a bit of a punching bag, right? Because in the last 12 months to 18 months, crude goes up. AI trade plays out. Something or the other, the rupee weakens. But at times, this gives you a perfect and a good entry opportunity for longer term investors. Come in on this AI trade, and we have a couple of large global IPOs that will play out. So there'll be some rush of money maybe out there. Will it signal a top?
So I think, it's a good point you're raising, that this whole, very often people say that, we have to be only copy of other markets and other. I'm not saying AI is not significant. AI is a very good disrupting sort of technology or change, which all of us will have to adapt and work at it. It will change the way we work, and there are different layers. Every country has strength in. India would have probably more strength in implementation because that's our legacy, that's our sort of strength and ability. So I do believe that first part, of course, value has been created by US markets and some of the companies which are going public. What worries me in that space is that I think it sounds like pretty much like .com, where lots of situation was there where the .com was supposed to disrupt the world and massive investment was happening, M&A was happening at crazy valuations, and we all saw what worked out. So to me, currently, a lot of questions started happening about the returns on the investments of you make in AI. If let's say about $1 trillion of investment is supposed to happen in AI, how the ROI is going to come from on that investment? Who will pay for that ROI? Will it be extra productivity? Will it be job losses? What will be bought? I think those questions are already beginning to happen. So I think we'll have to only see. Only time can say that whether it is a bubble or it is here to stay. There's no question on that. The thing is that whether investment point of view, whether it will make money from here or not, is the only time will answer. Our view currently has been that it sounds like more like a sort of euphoria and bubble from an investment point of view. And hence, we've tried to stay away more, where we think that we understand the risk reward of investing. That is where we would be putting our money on.
Got that. You want to tell us how your portfolio is constructed right now, Vikas?
I think it's, again, we've been very, very heavily invested into pharma, CDMO, healthcare space, which we've been very, very positive about. It has worked out very well for us. In financial services, which are, again, in companies which are growing at 20-25%, we have a good run, and most of the players we've been invested in financial services. So manufacturing, we've been a long believer, and last year it was a rough patch, but I think this year it's come back once the tariff issue sorted out. So I think for us, things don't change very often. For us, we believe in all these things which I talked about from a medium to long term perspective. We don't kind of do narrative-based investing. We do based where we see cash flow moving, profit growth moving, ROE coming through, and more importantly, we can understand the risk reward. Very often, there may be a good investment opportunity, or if you don't understand the risk reward, you should not be betting on it. So we avoid it. So our portfolio has remained by and large around the theme which we've been continuing for a lot of years.
Vikas, mentioned a few themes, but if you could tell us that one theme that is in for a multi-year bull run, that one theme that you're really bullish on, say, the 5-year horizon, could you name that?
I think the whole manufacturing space we've spoken many times over, and we think that India is at a very early stage of manufacturing replacing import substitution, export oriented stories, and that will continue over one decade, according to me. Our manufacturing GDP is around 15-16%. That's where a lot of government focus is happening. That's where a lot of opportunities are, both from import substitution, export oriented, and that spans across various sectors, whether it is auto component, whether it's chemicals, specialty chemicals, CDMO, capital goods. And within those names, you have to identify to the reward stories. But there are a plethora of them and plenty of them where we think that over fullness of time they will become 5x, 10x, 15x from where they are today.
This entire solar theme seems to be also doing pretty well. So an MV is up 1.5%. Vikram Solar is higher by again another 2% odd. Do you have a view on the solar theme in the manufacturing pack?
To the solar, meaning the renewable space. So I think again we currently don't own anything, and we believe that the first leg of that has played out. The competitive intensity seems to be intensifying in the sector. So hence we've kind of the valuations have come down. Most of the stocks have got derated in the last 1 year or so. So I think we've so far stayed away from that, and we keep watching. Currently, we don't know anything.
Okay, all right, Vikas. Thanks a lot for joining in. Wishing you a good day ahead. Always good to hear your optimistic voice. Particularly at times like these where people are getting a little bit jittery, but the flows, as you said, domestically have been stronger, telling you that the Indian investor is maturing a little bit. Hopefully, big returns over the next 5 to around 10 years for medium as well as long-term investors. But let's move on. As India looks to attract more foreign capital into the country, the CNBC-TV18 IBLA collectives asked the question, can GIFT City be the gateway to make this happen in a big way? My colleague Prashant Nair spoke with the top leaders from markets and the aviation sector to understand where we are and what needs to be done. Let's hear out some comments.
Omnibus investment. Undoubtedly, there is risk of round tripping. But omnibus, where a private bank or a wealth manager or an insurance repper makes investment on behalf of hundreds of their clients, is a globally accepted practice. If round tripping is not an issue in those jurisdictions, we will have to provide similar facility to global investors and global capital. Today, there are many foreign citizens who would like to invest in India. They have some connection with India, or they are interested in participating in India growth story. But they'll have to take a PAN account, PAN number, PAN card in India for investment. That's not going to work. So why not give omnibus facility to private wealth bank insurance pool so that they can collect money from their customers and invest via GIFT City into India?
If you created a leasing company in GIFT City and you want to remove the asset from an Indian airline to, let's say, a foreign airline in a third country, then the most efficient way to do that is if you have a double taxation treaty with the third country, which India has a few of them, perhaps not to the extent that Ireland has. And so, yes, over time, we will need to increase the amount of double taxation treaties we have to be able to create a stronger set of sort of taxation infrastructure for Akasa. I mean, the good news is we're an airline, not a leasing company.
Correct. No,
so as such,
on the other side, yes.
Yeah. So as such, we will continue to lease from third-party leasing companies that could be sitting anywhere in the world, and that doesn't change. I think the question that you asked has an effect on someone wanting to create a leasing entity in India.
Lessor sitting in GIFT City.
A lessor sitting in GIFT City. And that's something that, for that to be fully effective, we'll need to have a broader set of double taxation treaties.
I think India must do a campaign called Inevitable India to attract long-term capital and to attract high-quality talent back. How do we make it easier for onboarding, easier for the convenience of investing initially? Omnibus is one, maybe the digital KYC instead of having those physical instead of wet signatures, we make it very easy. And just to expand on the point of what Nilesh Bhai mentioned, that when you look at Clearstream, Allfund, those aggregators or the platforms, or you look at, let's say, Standard Chartered Bank as a custodian, globally they would be marketing different kinds of products in different jurisdictions, be it a UCITS fund, be it a fund in DFM, be it a fund in whatever in Singapore, or maybe a fund listed somewhere. A Gift City product doesn't get added there today because you have to do a completely separate onboarding exercise. If you make it easy, we market very strongly as a country, and all of us will put our might behind this to put like India as a great destination. This time, I think instead of doing some of those kind of like bonds and all, we should really try getting money from the NRIs in the equity market.
Today, if you talk about Gift City, it has arrived, it's got a status of Singham. So Chhava has actually morphed itself into Singham. So that's point number one. But that is when you look at it from an absolute perspective, from an India perspective. Because today, the Bollywood grosser, clearly the reigning Bollywood grosser, considering Dhurandhar and the sequel, obviously, both of them put together, that's the grosser. There, I think we yet have to arrive. So we might be a Bahubali there, but the Dhurandhar status is yet to be arrived. So that is the first up thought. So I think for me, the campaign for GIFT would be, do we know the acronym of GIFT? What is the full form? For me, it is Go India Full Throttle. I think that should be our tagline, because I think the more and more you kind of talk about Go India Full Throttle, and it's a great catch line for a concept like GIFT, because it's truly a gift.
Interesting one out there. Well, let's get back to the markets. The Nifty is struggling. We're down closer around 200 points. We're at a very, very crucial juncture. The 23,250 mark, that's where we are at. We actually breached it on an intraday basis. Yesterday's low was around 23,229. You don't want that to break on the downside. That could open up further downside from here on. And the first 15 minutes of trade have clearly gone to the bears. So it'll be difficult for the bulls to fight back. But it's back in the slot. So let's see how that goes. Broader markets, a couple of stocks doing well. One such stock is NMDC, because we learned from sources that they've gone ahead and they've hiked prices. On lumps, it's been by close to 200 rupees. And on fines, it's by around 150 rupees or thereabouts. And the revised prices that come up for you is 5,700 rupees on lumps and fines at around 4,850. Remember, this is source-based information. We're waiting for a clarification on the exchanges. I've reached out to the management as well. Not got a response till now, but I think these figures should be pretty much in line. It's effective from today. It's a surprise price hike, right? We're awaiting the monsoon. So ahead of the monsoon, Sunny, you see a price hike on a company that's already increased prices from January, February, March, April, as well as May. So this 150, 200 rupees is a bit of a booster shock. And we haven't seen any kind of price increase actually globally. To be fair, actually, international iron ore prices have come down a little bit. So that's why the street is lapping this up. Remember, the stock is reacting to this news positively. And the last few days as well, the numbers weren't very, very good. The production number was good, but the sales number wasn't very good for May. And now this price increase, street latched onto it. Stock now at the high point of the day, up close to around 1.5%. I'll tell you what, we'll slip into a short break. On the other side, we have Amish Shah of BofA Global Research, who will be waiting for us. He'll be joining from the sidelines of the BofA India conference. Stay tuned. Welcome back. Well, global cues in a bit of a tizzy, and that's why you have Brent crude prices that have spiked up. The geopolitical piece again has come back on the table, and that's what soured mood a little bit. And the Nifty is clearly reacting. Brent crude prices, I think, holding at around $97 a barrel. The rupee is a little bit weakish, and that's why, in fact, we are lower with a cut of close to around 200 points. But let's get in Amish Shah, Head of India Research at BofA Global Research, who joins us on the show. Hi, Amish. How's the conference going? What's the mood like out there? As good, as bad as you expected? Is there a fair amount of interest for India?
Hey, Nigel. Good morning. Interest, yes. Versus last year, the corporate attendees are up about 10-12%. Number of clients are up about 29%. So we are not complaining in terms of interest on India. Messaging is mixed. So there are, when you look at the long term, there are a lot of policymakers talking about how do we get out of this crisis, how do we bring the growth up, and we will discuss the details. Corporate India, on the other hand, is sounding a little more modest. They are cautioning that first half of FY27 is going to be impacted on the back of West Asia conflict, higher commodities, and a possibility of El Nino as well as rate hikes.
Okay. Amish, hi, morning. So in terms of policy expectations, what do you think could be on the anvil now till the end of this year, FY27? Because you spoke about policy imperatives in our past conversations about energy security, maybe even shipbuilding. That was a theme you referred to last time around. So in terms of realistic expectations on the policy front?
So, Reema, energy security was debated and discussed quite at length. Variety of policymakers all acknowledge that it is a top priority. There is a lot of discussions going on, and they want to address all forms of energy security, including biofuels, including coal gasification, more electrification, more oil and gas exploration. So everything's on the cards. Meaning, obviously, they are trying to come up with what would make it viable, where is there a need for subsidies, how do we make it exciting for private sector capex and SOE companies or PSU companies to get in a big way. So I think it will take some time for the policy drafts to be out, but definitely it's up on the agenda for policymakers right now. The other thing that we learned was there's a debate going on, as you would agree, that will the central government cut capex in order to meet its fiscal deficit targets, or will they continue with capex in order to promote growth? The policymakers are arguing for the latter. They want to continue with capex as is. There is no curtailment that they are expecting. And on the other hand, a lot of auto companies are talking about that post the West Asia conflict, they've already seen a large demand for EVs, and some of them are starting to see supply constraints. So they're now talking about ramping up their production capacities on the electric vehicle side. Final thing I would say is also on power distribution sector. There is a debate within policymakers on whether we should fix the problems of that sector through legislation changes, or should we do it the other way. But clearly, power distribution reforms are also on the cards.
Okay, all right. Amish, what about, in terms of earnings for this year? Do you think that, they have seen some kind of trimming back in terms of earnings expectations, and ultimately a market is driven by earnings, right? Growth, earnings, both those two have been missing, and FY27 is supposed to be a better year. Are those hopes fading away if there's going to be capex cuts, if we're going to have elevated crude oil prices, and the economy is going to slow down a little bit, not even considering that the RBI hikes rates till the end of this calendar year?
So there, Nigel, as you know, we have a somber message. We are already working with 8.5% earnings growth, which is much weaker than the 15% that we have from the consensus. We do think that every result season will act as earnings cuts from the street. And, going back to my earlier point, the corporate India at our conference is also cautioning investors that at least the first half of the fiscal 27 is going to be impacted on earnings. The other pattern that I have picked up is that earnings are going to be more of a challenge for B2C companies as opposed to B2B companies, because B2C companies are finding it very hard in the current environment to pass on the cost pressures through price hikes. B2B companies, on the other hand, are still talking about price hikes, even if it comes at the cost of weaker volumes over time.
Amish, did you manage to convince the foreign investors about India to put in money in India? Or it's a hard sell?
So, Reema, look, we are definitely arguing the themes in India and the long-term stories, etc. And they're all convinced. It's not as if people have given up on India, going back to my point about 29% higher participation at our conference. But to be realistic, I think most foreign investors are trying to do their homework in order to be ready of what they want to buy, at what price they want to buy. But unlikely that foreign flows are going to turn meaningfully positive anytime soon.
So, Amish, if I have to ask you your learnings, based on the conversations that you had with corporates, policymakers, even from an investor point of view, what challenges the current thesis that you have about any sector, if you could like that? Maybe you've gone it back and said, well, this is where we got it wrong and we need to re-look at it. Or any conversations which have reinforced their view, or you now come away saying that, guys, this is the top theme we need to bet on. It's a structural up move for the next 4 or 5 years. So on both places.
So, Rima, on the reinforcing our view, there are plenty of things. We were bullish on, let's say, the non-ferrous metals. That commentary is quite strong. We were bullish on financials. All the financial companies are talking about that NIMs may be a bit of pressure, but everybody's arguing for improving loan growth, etc. We were quite optimistic about the energy security piece that we spoke about, and that was dependent on policy action. There is indeed a policy action. We were hoping for a good window available to do reforms because there are no elections until February of next year. Government is talking about doing reforms. So all of that is basically reinforcing our view. And on the bigger picture, we were arguing that FY27 earnings will get cut. We are already the lowest on the street at 8.5, and it seems that the street will eventually converge with us. So I think all of this aligns with our view. In terms of surprises, I would say I was negatively surprised in the telecom space because most of us are expecting a tariff hike. That seems to be very tough in the current environment. So that's a negative. On the positive side, we were of the view that capex curtailments from the central government is very likely because otherwise fiscal deficit targets and debt to GDP will start to look a concern. But the government policymakers are very clear that they are not going to cut capex. They are in fact arguing that can we cut leakages, can we improve the efficiency of subsidy distribution, and on the back of that efficiency savings, can we continue with the balance of fiscal deficit and capex.
So now no telecom hike till when, Amish? You said you were negatively surprised. Street was hopeful that maybe in the second half of the year we would see one. So now you think this has been pushed forward by another 1 year, 1.5 years, even longer?
Yeah, so it definitely doesn't seem like a calendar 26 event, Rima. So it's now wait and watch because inflation is already on the rise. It seems that the telecom players are not very confident of taking a hike in the current environment. But in case if the West Asia conflict were to resolve, inflation were to roll back, perhaps that is a time to do it. But it doesn't look like this calendar year event. Obviously, telecom companies are arguing about that it will still lead to ARPU continuing to grow on the back of premiumization, and which is all very good. But the tariff hike seems to be pushed out to next calendar.
You touched on a few sectors, but you didn't tell us what people are thinking about the AI/tech theme and how is that playing out. SaaS companies globally, they saw a bit of a bounce back of late, and that had a positive rub-off here in India as well. But what's the feedback?
So, Nigel, all the foreign investors are still, having a consensus view that AI capex will continue to accelerate. This is still not time to take the foot off the pedal in Korea, Taiwan, if that's your question. But if you think it from the flip side of IT companies are actually also having a positive story to say here. So they are arguing that enterprise AI investments or capex has already started, and it's started faster than what they would have expected. And as a result of the AI spends by enterprises, they are in fact arguing that the deflationary pressures of revenue growth that we had seen in IT, it is already a bottom. So we are for the large cap companies in IT, as we know, revenue growth is already down to 2 to 3%, constant currency terms. They are arguing that 2 to 3 is now a bottom. On the back of AI investments, that growth will now start to creep up. But there is no further deflationary pressure.
And going back to that point about that there's a lot of debate on whether the central government will be cutting back on capex, and the key takeaway seems to be that no, they're not. So the capex spend remains intact. From an investment point of view, what does that lead you to?
So, we were positive on certain pockets of capex. We were more excited about the industrial companies that fit into the energy security theme, because that's where we thought capex will accelerate. We were also positive on shipbuilding and defense. So shipbuilding, defense, energy security, and data centers. So that is a pack of capex companies that we were optimistic in general. It seems that it could be more broad-based if the government capex spends continue.
All right, Amish, it's been so great chatting with you. Thank you very much for joining in.
Pleasure.
Have a wonderful last day at the conference. Very insightful conversation coming through, but let's move on because we've got another management waiting by, the one of CMR, Green Technology, and we've got an IPO KYC lined up with them.
Well, that's right. Let's get straight to the management then. It's a 631 crore rupee IPO that opens for subscription. The price band should come up for you on the screen. Let's find out what's the strategy ahead. We're joined by Mr. Mohan Agarwal, the chairman and MD of CMR Green Technologies, who joins us on the show. Hi, Mr. Agarwal. Good morning. Good to see you in. And all the best with this IPO. In terms of valuations, I think the bankers have done a good job in terms of pricing. So good on you on that. Let's see how demand goes, because if I compare your valuations with the rest of the companies that are already listed, it seems fairly attractive. That said, we need to understand business. So let's go straight up. What's your current capacity utilization levels? Most of your money comes in from the aluminium recycling vertical. So tell us, what is your utilization levels? And I see you have much higher capacity in comparison to your peers. So what is the targeted capacity that you're looking at?
Thank you very much, and good morning to you. Before I come to your question, this is the first time we are coming to the market. I would just want to give you a perspective of overall what is our business. I started working in 1986. In last 40 years, recycling and primarily aluminium is the only thing that we have done. It has always been my dream that we build an organization which will last more than 100 years. For that, the foundation has to be extremely, extremely strong. So what we have worked on the foundation is that we, built on the governance. We have an independent board for more than 10 years, even though we are now coming to the market. Then we very strongly focus on innovation and technology. We are amongst the top adopters of technology from across the world. People are a very, very important aspect. So we work as a people-first organization. And lastly, growth is extremely, extremely important. So we focus on growth all the time. So having said that, we have grown, we've been growing at nearly 23% since our inception 20 years back. We put up 7 plants in the last 6 years. Mm-hmm. So having said that, coming to your question, we are 4 times bigger than our nearest competition in India. We are also amongst the largest in the world. We have a total capacity of about 605,000 tons. 2 of our large plants are in the ramp-up stage at this moment of time. So we recorded a 70% capacity utilization, which is ramping up further.
Okay, 70% utilization level, right? That's what you're saying right now.
Yes, sir.
And in a business like yours, can you go to 80-85%, or is there or 90%, or is there ballpark for the industry it stabilizes? I mean, the peak level is 80-85%.
In certain businesses, like we have been up to now targeting the auto business, okay, where we have a 45% market share, and where our capacity utilization kind of peaks out at about 70-75%. Okay. Now we have added a plant for billets and sheet ingots. There we can go for about 95% capacity utilization. And we have also added one more plant where we recycle beverage can and supply liquid metal to Hindalco Industries. Right. So that is again, we can go to about 95% plus market share. One very strategic thing that I would want to point out here is that this venture of ours, where we are bringing the recycled metal to a primary producer, is something which is very futuristic or is very strategic for us, because in the decarbonization effort of the primary producers, everyone will have to have a recycled metal in their portfolio. So we getting a first start with that gives us very good growth opportunities in the future.
Got it. Okay. All right. And your market share currently is around 10 to around 12%. You're satisfied here? Or in the coming years, do you see you would like to have a higher market share?
Look, of the auto space, recycled aluminium, we have a 45.
Mention that. Yes.
Of the overall recycling space, we have a 17% market share. We obviously would want it to go up. I mean, 10 to 12 is wrong. It's 17% as of FY25. 17.
Oh, you're saying you're at 17%. All right, because we got various presentations and various research reports that came out, but we'll correct that. 17% is what you're saying, and you want to hold on to that market share, right?
Yeah, grow it actually.
Or grow it towards 20-25%, say in the next 3-4 years?
I would target that.
Okay, got it. Global Scrap Processors, that's the entity that holds stake. And I think 80% of this OFS is going to be, because of them. The core promoter entity is diluting very, very little. What will their share be post this dilution? Are they totally out?
No, they will still continue with 1%. They have 13. They came in about 13 years back. They've been a very consistent, a very patient investor with us. And they still want to continue with 1%. Even after 13 years, they don't want to exit completely.
13 years ago, what kind of valuation did they come in at?
They came in at a very low valuation. I think they are getting pretty multiple, tens of multiple. They are getting a very, very good value.
Okay. Let's focus on a couple of other aspects. Your debt, the last recorded number is close to 900 crores, I think. So could you help us out with what is the net debt in your books and where do you see this number headed?
The net, we have always maintained a debt equity ratio of close to 0.5.
Okay.
Because of the increase in prices and also the capex that we have done recently. Large capex, so it has gone to about 0.76. I expect the debt should come back to about 0.5 in future.
0.5.
That's where we have always been, because as the new capacities are ramping up, our debt equity ratio will also come down.
Got it. Tell us about your revenue mix. Currently, aluminium is close to around 80% of your mix. Would you like to maintain it around these levels? And if I look at it, automotive as well is one of the dominant factors, right? It has a large share and it's moved up over the last few years. So what should the mix be on both these two parameters? Aluminium as a contribution of total sales and auto as a contribution of total sales?
Out of aluminium, the auto comes within aluminium.
Yes.
So the 78% aluminium portion that we did in FY25, auto constituted 90%. Now this auto's constitution will go down as we will do more sheet ingots and beverage can recycling and billets. On the other hand, we do the balance 22% was furnace ready scraps of brass, copper, zinc, stainless, magnesium. So we are a non-ferrous metal recycling company with focus on aluminium.
Okay, what I was trying to understand is auto segment is better margin business or margins are the same? Because I was observing over the last few years from 3.5% of margins, you moved to around 5%. So does this mix change the trajectory of the margins? And do you believe that margins can continue to improve from here on, say by that 50 to 100 basis points per year?
Look, one auto is a good business. The other business that we have added are also good businesses, both from margin perspective and consistency of the business. So all of the businesses that we have added are good. We are continuously innovating. We are continuously taking steps to up the technology, to better the quality and to reduce cost. So with all those things, we believe that our margins should improve as we go forward.
Okay, you believe that margin. So, currently you're ballpark around 5.5% odd. Say in the next few years, it should move, say, closer to around 7% or thereabouts. That would be the aspiration?
I would not, as an aspiration, you can say yes, but we more concentrate on ROCE. And then it's a reasonably good ROCE that the recycling sector provides.
You want to tell us what is your targeted ROC? I think your legal team is, cautioning you. Make sure you don't give any forward numbers. We are talking about aspirations. Tell the legal team, you're in line. What is the targeted ROC you're looking at?
Again, they say don't give me a number, but it will be in line with what you are getting for the other recycling companies, or slightly better than them. That is what would be our target.
Okay.
So that's what.
Okay, one risk is that your sourcing of your raw material. I understand most of it, I think around more than 45% of your imported scrap is sourced from the United States. You could correct me on that number. And do you believe it's a risk, or do you believe you're well guarded?
The sourcing from United States is a major sourcing. That's because United States produces the most scrap and sells the most scrap, exports the most scrap in the world. And we have our own 100% subsidiary there, which buys. As far as our risk is concerned, we are present across the whole world. We buy for more than 73 countries, thousands of scrap yards across the world. So we are very well distributed across the world to be able to source. So I don't see it as a risk. And US sourcing about 47% is also within, it's not a risk.
Okay, you don't believe it's a risk. Final question, sir. What is your capex plan? Because this OFS money is going to, to that large entity that invested and made multi-fold profit over the last 13 years, and some part goes to the promoter entity as well. So what is your capex plans? I wanted to ask you, because I'm looking at your operating cash flows in FY25 at least, it was negative. Could have been due to some one-offs. But how do you fund this capex plans? If you could help us out.
We have been funding our capex through internal accruals. Going forward, also we generate enough cash that we will be able to fund our capex plan, and that is why we have not taken primary in the company.
So operating cash flows turn positive, right?
Yeah, absolutely. And that negative is because of capex and larger working capital requirements because of increase in prices. So that.
Put a number, sir, to that capex plan per annum. How much is it? I think you've been doing 100 to 250 crores per year on capex.
Look, in the last 2 years, we did 500 crores of capex.
Oh, yeah. So 250 crores per annum is something that you will be looking at?
I cannot give you a future number at this moment of time, but yes, we would want to. We are a very growth-focused company.
Yeah.
So it all depends on what is the opportunity that we get.
Okay.
As we get a good opportunity, we will definitely. Capex is not a limiting factor for us.
Got it. Okay, Mr. Agarwal, it's been a pleasure talking to you. Wishing you all the best. As you said at the start of the interaction, you're a bit of a doctor in your industry. A recycling doctor, one would term it as. And wishing you and all the team all the very best. On listing day, we'll push you a little bit for your numbers. I'm sure your legal team will permit you at that point of time.
Before.
All the best for the issue.
Thank you very much.
Quick check then on the sensex options data. So let's get a couple of strikes up for you. The Nifty as well as the Sensex, both of them are lower, as we have been covering for the last hour or so. Both of them are down. Now the Sensex is down close to 750 points. And the options data is quite interesting because it's telling you that there is some caution out there. Take a look at the 73,900 call. That's fairly active in today's trading session. And the premium, yesterday had ended at around 1,016. Now that premium has come down to around 400 rupees odd. That's obvious, right? Because the direction has gone not, for the buyers. It's gone inverse. So that's why you're seeing some erosion in terms of the premium. there's clearly writing we're seeing at those levels. And since, the world has gone into a bit of a tizzy and we don't know what the geopolitical issues that could crop up in the next 24 hours or so, and we have the weekly expiry that plays out tomorrow, that it appears there's some deep out of the money put buying. The 72,500 put, just pull up the premium of them. That's moved up from close to around 9 rupees to around 23 rupees. So there is some put buying. In case things go wrong, then those put buyers will make money. There's something even deeper because 72,000 put as well has opened up. I'm highlighting this because both of them are fairly active. The premium out there as well has moved up, and that's quite out of the money as of now. But that's telling you that there is some protection buying that we're seeing on the downside, and there's aggressive call writing. And since the 73,900 call is seeing a fair bit of addition and fair bit of writing, you put in there the 1,100 rupees of premium, the 75,000 mark becomes an extremely important resistance mark. And then you have the 20 as well as the 50 DMA. And over the last few weeks, we haven't been able to cross that mark decisively. I recall a couple of weekly expiries ago as well. We went to that mark and we did a bit of a U-turn. So that's the crucial resistance mark on the upside. And looking at the options data, the bulls will believe at least they've got the 72,500 odd mark covered. For the time being, sensex down 750 points. Take a short break, come back. Manisha Gupta is waiting for us on the other side. She'll tell us what's going on in the commodity markets. Stay tuned.
Welcome back. Let's talk commodities now. Manisha Gupta joins in as always. Manisha, top of mind is crude, and we knew about Karg Island. There's a new island I learned over there, Kesham Island. So tell us more what's happening.
Oh, well, yes, never a dull day when it comes to crude oil. And we are looking at very, very volatile prices continuing into this one. So overnight was a strong gain. We are holding around that $97, $98 a barrel mark. There are reports of Iran firing missiles at Kuwait and Bahrain. And there are similar statements coming in from US as well on how they are shielding it. Also, diplomatic talks between US and Iran seem to have kind of broken with the kind of statements that we are hearing from various state media agencies, especially in Iran there. Also, when you look at the U.S. crude inventories, well, we have seen a decline for a 6th straight week onto that one, and this time around by 6.8 million barrels. It has been a constant draw that we've been looking at in the U.S. crude inventories, also supporting prices there. Also, when you look at the actual physical molecules of jet fuel and diesel are trapped behind the blockade. So the markets believe that the crude oil may come faster, but when it comes to refined products like jet fuel and diesel, that could take even longer to start coming back to normalization as and when Strait of Hormuz opens. So when you look at the U.S. global reserves therein, the U.S. is holding at around 357.1 million barrels. This is the lowest since Jan 2024. So multi-year lows in sense of U.S. reserves there. Also, when you look at the IEA members, and remember, IEA has released 400 million barrels. 50% of that has reached market, but 50% of that hasn't yet. And IEA members also are holding reserves much lower at 1.55 billion barrels versus 1.8 billion that they were holding in the month of Feb 2026. And China, of course, has the largest national strategic reserves, holding 1.4 billion as a single country there. When you look at various statements that have been coming in from major producers and market traders, they believe that the crude prices would go much higher from here on. This is from Toril Basoni of IEA. She's the head of global oil there. She says that it could take 6 to 8 months in a best case scenario if the reopen of Strait of Hormuz was to happen today, and then 50% of 400 million barrels has been released via IEA there. So according to IEA, it would perhaps take nearly 6 to 8 months before we can see any kind of a normalization coming in for the crude there. There also is a very strong statements coming in from MD of Bahrain, who's Tom Baker. He says that the market is underpricing the risk from Iran war right now, and the West Asia conflict has taken nearly 14 million barrels per day off the market. Much of that, of course, comes in from Middle East. He also says that the crude prices may come back, but refined products, of course, are going to take a longer time there. And that is Daniel Haynes for you, ANZ. He says that any efforts to reopen the Strait of Hormuz is facing challenges because Iran has mined large portions of the vital waterways there. EDNOC and various other large producer countries in any case have been telling us that the markets are calm, but they will likely be shattering by August 2026 because once the global peak summer demand hits and domestic reserves deplete, the market is facing a violent upward correction. And that is the view coming in from various global banks as well, which believe that by the time it's June end and July end, you could be looking at crude oil prices anywhere between $95 to $120 a barrel on the higher side. Why is crude not trading at those levels right now? That is because it is the Chinese demand has kind of declined. Average China demand in 2025 was 11.5 million barrels per day. China also continued to buy 1 million barrels per day in sense of stockpiling in 2025. So it is sitting on a very large, comfortable stock therein. If you look at Jan to Feb, China was looking at 11.47 million barrels per day of a demand, which is 16% higher on an year-on-year basis. And then came March, and we saw the Chinese imports decline by 3% because the crude oil prices had surged. And then in the month of April, the Chinese imports fell even sharper by nearly 20%, which is a 4-year lows in markets therein. So it has been a very sharp decline that we're looking at in sense of Chinese demand. China has been buying when the crude prices were at 60s and 70s. As the prices went to 90 and 100 and beyond, China clearly is out of the market there. The other thing really is about the Chinese volumes. While they have declined 23% for the month of April, that has freed up the global supply, and that is where markets are taking cues from. Russia, West Africa, Atlantic Basin have supply to Asian consumers, so we've seen that premium go down a bit. And then China's new EVs are nearly 50.8% of the automotive market, so electrification really seems to be surging in China, lowering the demand for crude there. Is the reason you're not looking at $100 a barrel right now. But then apart from that, it also is about the backwardation that the markets are in. So spot is higher and the future markets are trading on the lower side. And that is what the paper crude oil is looking at. Apart from that, it is the broader financial markets which are working with a demand destruction going forward, also weighing onto the prices. But if this continues for the month of June or even July for that matter, we are definitely preparing ourselves for higher crude prices.
Thank you very much for that. Let's cut across to SBI Chairman C.S. Setty's keynote address at the Citi India Conference.
It's a 7-year journey that where we started sometime in 1988. I joined in the bank, December 1988, quite some time ago. And the journey of these 37 years also a tremendous journey for the banking industry in the country. A few anecdotes which I would like to share. In 1988, when we joined SBI, Indian banking was dominated completely by the public sector banks. Virtually no private sector banks in the country. And the government of India, through the RBI, wanted to implement computerization. They didn't call it computerization, they called it mechanization. They wanted to bring machines in the banking industry. And every employee, union, association pushed back that we don't want machines. And very typical Indian jugaad, what the government has done is that they have given a computer increment. Anybody who uses computer will get an increment. So all of us, of course, got the increment. And the story of computerization of India and banking in particular and payments in general is an amazing story, right? Where you have started in 1988 and where we are today. Similarly, sometime later, 4 or 5 years later, I was a branch manager in one of the small branch. I remember having, in India, the districts are headed by collectors. They are the district administrator. In one of the days, one collector walked into my office and said that I want 20,000 rupees, clean overdraft. He didn't have, I need to pay a fee to my son's education and my account is elsewhere. So I need some money here. I told him, sir, there is no clean overdraft facility. I can't give any clean loan. Unless you have a deposit with me, you won't get a loan. And then 5 years later, just before this liberalization began in India, we were taking 400% cash collateral to open a letter of credit to import anything into India. So this is where, we all started maybe 30, 35 years ago. Today, everyone chasing a retail customer to give a loan, everyone chasing a business to give a seamless SME loan, everyone is changing every particular segment, whether it is a microfinance, whether it is SME, whether it is a corporate banking, and the banking has definitely played an important role. The way the country has progressed over the last 3 to 4 decades of my journey in SBI, I thought I'll set the context from there and let us see what exactly the Viksit Bharat and the banking role is going to play. So first of all, again, very good morning to all of you. And as I said, it's a privilege and pleasure to be here today at the City India conference. I didn't expect to be such a massive gathering, but I think I must compliment the city to organize such a wonderful event. And as Amol mentioned, I think it's a time when the whole global economy is navigating geopolitical uncertainties, shifting supply chains, technological disruption, and changing patterns of capital flows. I thought I've seen everything, but every year brings new dimensions of challenges. But India stands out as a source of stability, resilience, and opportunity. Don't look at sensex. Look at India as a long-term story. I think that is what I'm going to talk about now, that Vision India 2047. You are all familiar with what we talk about 2047, essentially the 100 years of independent India, and where India aspires to become Viksit Bharat, the developed country, and provide at least improved per capita income to $10,000 and be called a developed country. So India's story is no longer merely about catching up. As I said, the context, it is actually emerging as one of the defining growth stories of the 21st century. Increasingly, it is helping shape the global future. Over the last 2 decades, living standards have more than tripled, with the GDP per capita increasing to $2,700. It's still low, but it increased from $800 in 2006. Hundreds of millions of people have been lifted out of poverty. I think it's very, very significant. When I was a child in the school, we used to get, in a government school, a wheat from US under the scheme called PL 480. We all used to wait for that wheat because that used to give the midday meal to many of the students, millions of students those days. Today, I'm very proud to say that India is surplus in the food grain production. And India has established itself as the fastest growing major economies in the world. But the most remarkable aspect of India's rise is not simply the pace of growth, it is the ability to deliver transformation at an unprecedented scale. And throughout this journey, the banking sector has been far more than a provider of financial services. It has been a critical partner in nation building. The most distinctive feature of India's developmental journey has been the creation of a world-leading digital public infrastructure. I think you're all familiar with the DPI, JAM Trinity. I think they've been spoken quite a lot. But the digital prowess, what India has developed, particularly in the payment space, is amazing. And you must have read extensively that today, UPI handles 200 billion transactions every year. And very proud to say that SBI handles 30% of that volume. If you see the volume of transactions and the capacity what the system has developed, SBI alone handles almost 250 million transactions every day on UPI.
Well, interesting conversation there. But for now, we need to slip into a very short break because on the other side is another interesting and important conversation. Lata will speak to Amol Gupte of Citi on the sidelines of their investor conference on the mood of foreign investors.